Good afternoon, this is Sean Golding with Golding & Golding, here to go a little further into Form 8854. We get a lot of questions about this form. There's a lot of bad information on the World Wide Webs, right? So you got to be careful, okay? At the end of the day, it's just a form. It's filed with your final tax return. It doesn't have to be perfect, as in you do the best you can to make sure you get it in timely. You don't want to not file the form, and you don't want to file it late if you can help it. Really try not to get too overwhelmed, okay? The 8854, quick little baseline, 8854 is the initial and annual expatriation statement. It's something that's filed in your final tax return year. So if you were to renounce your U.S. citizenship in 2024, or you were to submit your I-407 in 2024, then in 2025, when you file your final tax return, you will include a copy of the 8854 as part of your filing, the original, as part of the filing. Some people think you file it the moment that you renounce. That's not how it goes. It's a tax form, right? You've got renouncing and sending in your green card and all that kind of stuff. That's an immigration component. This is the tax component, so it's part of your final tax return to let the IRS know that you've expatriated. Okay. All U.S. citizens have to file it. Only long-term lawful permanent residents, which typically means you had the green card in 8 of the past 15 years. It doesn't have to be full years. If you made 8833 treaty elections during that time to be treated as a non-resident alien for tax purposes, you may be able to avoid that 8-year. And if you think you're coming up on the 8-year and you think you're going to do it in the final year, be careful, because that can be considered a trap. A type of, it's like expatriating. If you file that form and request NRA status on an 8833 treaty election, well, guess what? Then that's considered the formal expatriation. So let's go through 6 important facts. These are just basic things to know. It can get more complicated from a preparation standpoint. But again, remember, this may presumably be your final U.S. person tax return, depending. So the first thing is, people hear the term covered expatriate. Oh, I only have to file it if I'm covered. That's not true. You file the form if you're a U.S. citizen or a long-term lawful permanent resident. You may or may not be covered, but from a baseline perspective, you file the form if you fall into either one of those 2 categories. In other words, even if you're not covered, you still file the form. There's 3 main ways you could be a covered expatriate: the net worth test, the 5-year tax compliant test, and the net income average tax liability test. For the latter, for the third, the most important to know about that net income, well, there's 2 things. One, it's net effective. So if you paid $1 million in foreign tax, you got $1 million of foreign tax credit, so you have zero tax. You have 0 taxes due. Net effective, you wouldn't meet it because you can consider foreign tax credits. But if you're filing joint, you have to use the joint return even if only one person is expatriating. In other words, you don't split the return. Even if you would otherwise be covered, you may qualify for an exception, the minor's exception and the dual citizen exception. There are specific requirements for those exceptions, so it's not, you should look through those before you take the leap that you are excluded from being a covered expatriate. If you are covered, that does not necessarily mean you will owe exit tax. Okay, that's something very important to consider. The examples I like to use: Joe has $100 million in the bank, and that's his only asset. Poor Joe, right? Well, Joe's going to be covered because he meets the $2 million test, but he's not going to have an exit tax. Jane has $4 million of stock that she purchased for $1 million. There's $3 million of captured unrealized gain, and so she will be covered. She will have to pay an exit tax, presumably, on the unrealized gain. When you're doing the balance sheet to determine if you are at the $2 million mark, it's important to note that it's not just the asset, it's losses as well. So maybe you own a home, it's worth $3 million, but you have a $2.6 million mortgage. So that means, that's $400,000 equity that you have. It's not $3 million for the $2 million covered expatriate test. If you are covered and you have eligible deferred compensation like a 401k, it's irrevocably waived, treaty benefits. So when you're considering the 401k, you use that to determine whether you meet the $2 million mark. And if you do and you're covered, then you don't pay exit tax when you expatriate on the 401k. In other words, it's not deemed distributed. But down the line, when you get distributions, remember, you'll be a non-resident alien. There's a 30% withholding for FDAP. Now, if you're not covered and you're in a treaty country, you can normally file a W-8BEN or elect to have a reduced withholding, 15%, 10%, 5%, 0, depending on the country. But by signing it as a covered expatriate, the 8854, you irrevocably waive that right. And the final thing I want you to remember today is that even though filing this is a pain in the butt, if you have certain types of trust or compensation, deferred compensation, you may have to file it in subsequent years. It is an initial and annual expatriation statement. So if the only thing making you file this in future years is potentially that you have these deferred compensation or trust, you may want to consider planning around that so you don't have to continue filing. We have a ton of free information available on our main website and our sub-websites. You can always reach out and schedule a reduced fee initial consultation if it's appropriate to your matter, and it's something that we handle here. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Have a great rest of the day.